It's almost 11 a.m. in Singapore and 1 p.m. in Sydney. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. China's benchmark stock index set for its biggest weekly gain since 2008 as officials pledge to increase fiscal support and stabilize the property sector. Investors also looking ahead to the Fed's preferred inflation gauge and a snapshot of U.S. consumer sentiment. That's due later on Friday for more clues on the rate path. And the yen extends a decline on the possibility Sanae Takaichi, an advocate for loose monetary policy, might win today's Japanese ruling party leadership vote. Okay, let's take a look at how we're tracking on markets this Friday in the Asia Pacific. Very much a risk-on sentiment in China. Got the Hang Seng Index better by 2.7%. The CSI 300, as we mentioned there, having another very good day, better by 2.5%. Set for the best week here since 2008 now. We saw the Golden Dragon Index in the US earlier jumping 11%. So what have we got? Triple R cuts becoming effective from today. 14-day and 7-day reverse repo rate cuts. The 7-day cut to 1.5% from 1.7%. And the Ministry of Finance apparently going to issue $284 billion in special sovereign bonds this year as well. Some of it to be used for stimulating consumption, some of it to be used for helping local government with debt problems. So a whole heap of stimulus headed China's way, and that's helping propel equities strongly higher. Elsewhere, we've got the Nikkei better by about 0.1%. Here in Australia, kind of flat right now, although the materials sector, obviously connected to China, are doing very well also. All right, well, we've got China's top leaders, meanwhile, ramping up efforts to revive growth, pledges there to support fiscal spending and stabilise the property sector as well, giving new momentum to stimulus measures. For more on this, our China correspondent Min Min Lo joins us in Hong Kong. So, Min Min, when you're looking back at the Politburo meeting yesterday, what really stood out?
I mean, it was really an extraordinary meeting, right, given the timing of it. September typically isn't a time for the Politburo to discuss the economy. That's usually reserved for the July, April or December meeting. So the fact that they use this meeting to discuss the economy shows the urgency that the government has when it comes to tackling the problems of the economy. They're really throwing their whole weight behind meeting that growth target for this year. And what really stood out is the language around the property measures, the readout saying that the mandate now is to stop the decline. Now, that's a phrase that has never been used before. And it's clear that the window for deflating the property sector is now over. The focus now is really to stop that slide in home prices, the slide in home sales, the downturn that's been going on for 3-4 years now. And then when it comes to the fiscal stimulus, the language says stepping up fiscal spending as necessary. A little bit vague, so we're waiting for more details, but Reuters is reporting that the Ministry of Finance is looking to issue some 2 trillion yuan in special sovereign bonds. Now, that is a big off-budget fiscal push here. Half of that, according to Reuters, is going to help lift consumption and half of that to tackle local government debt. Now, this is a departure from past language. In previous Politburo meetings, they often use the term a proactive fiscal policy. They didn't use that this time. And when it comes to monetary policy, again, the language says forceful implementation of interest rates. What we've seen before is a prudent monetary policy. That's a word that has been omitted as well. So clearly, a very significant shift in the tone here, showing a lot of urgency to tackle some of the problems in the economy. And it's that coordinated announcement back to back to back from Tuesday to Wednesday to Thursday, right? That's bringing all the animal spirits back into the Chinese markets.
I guess the key question here is it going to last? How sustainable is this policy impact going to be?
Yes, so right now the verdict is still out. If you look at what economists have been saying, it's pretty mixed. Some people say this is that bazooka stimulus that we were hoping for, that we might be on track to hit that growth target this year. But then you have the likes of Goldman Sachs holding on to that 4.7% growth target, saying there's limited upside risk to the growth forecast this year. Still, the verdict is still out, you know, given that, I mean, it's undeniable that the traders are coming in, buying into this story, but then then longer term, will there be a structural shift to the fundamentals of the economy when it comes to boosting consumption? Will it lead to a structural shift in terms of income redistribution and the confidence returning to the private sector and the property sector as well? That readout gave a nod to existing measures like the cutting of mortgage rates, reducing home buying curbs, but those haven't really moved the needle significantly so far. So will there be more measures? Will the government step in to be the buyer of last resort? Will they widen the use of those local government bonds to buy unsold homes? Those are things that we still need to see for the next weeks and months.
All right, Bloomberg's China correspondent Min Lo there. Just want to get you across an alert on the Bloomberg. We take a look at the Shanghai Composite. It is currently up about 1% at the moment, but the Shanghai Stock Exchange saying it is experiencing delays. The Shanghai Exchange saying it is investigating those delays. There isn't an official statement out from the Shanghai Stock Exchange, which we are currently translating. So we'll have more details for you in a little while. But here we go. Here's a bit more information. Exchange is concerned that after the market opened today, there was an abnormal slowness in transaction confirmation in the exchange's bidding transactions. So paying attention to that, investigating the relevant reasons, and asking anyone encountering problems to contact the securities company. So the Shanghai Stock Exchange putting out a statement there on some of the delays that it is experiencing. Let's get back to the stimulus that we've seen in China now. The key question for investors is whether that rally in China's markets can be sustained. For more on this, let's get to our Asia equities reporter, Winnie Su in Tokyo. So, Winnie, we can already count billionaire David Tepper among the bulls. He says he's buying everything tied to China. What are investors most excited about?
There is a lot of bullishness in the market right now, as you mentioned, and also the delay of the stock exchange just now also can point to kind of just traders rushing into putting orders into the market as well. So, you know, a couple banks are also jumping in and saying that, for example, we've got Goldman Sachs, the other just overnight had a note saying that this time it's really different for China. And Morgan Stanley said that there's another about 10% upside to the market. And we also saw UBS still staying, holding that overweight on China, but saying that the benefits can potentially broaden out to Korea and to Taiwan as well. Yesterday, I spoke to Man Group and the world's largest hedge fund. They said that, you know, we're seeing this just being the very beginning of the policies to further broaden out, and China, the government potentially start to lift the country outside of the deflationary cycle. So these are all very positive things that we've been hearing from the street. But also, when you look at the technical side of things, the Shanghai and Shenzhen, the turnover was actually over 1 trillion yuan for both of the for consecutive days, yesterday and the day before. And we have the CSI 300, the onshore benchmark, set for its biggest weekly gains since 2008. So yeah, it's just we're seeing so much sentiment turning more positive over the past couple of days.
Yeah, you did utter the words, this time it's different. That's kind of a meme, really, isn't it? There's obviously some skepticism about, and we've seen similar run-ups this year as well, and also leading into holiday breaks that ended up fizzling out. So are there any notes of caution out there?
Yes, absolutely. You know, when we talked to traders, they were saying that the sentiment right now felt like when China exited COVID. So investors or these big funds are buying into the rally and are afraid that they're going to miss out. But it can just be a technical rebound as if we don't see more policies to come in and follow through. So when we talked to East Spring Investments yesterday, for example, they were saying that they are doing some sectoral rotation within their China funds. So they're rotating into growth stocks, but out of some of the defensive names. But they're not yet ready to add more Chinese exposure to their original funds because they say they're not in a big rush and they would like to see more strength in the economic data to feel more confident about the current situation, because it just has disappointed so many investors over the past couple months, as you mentioned.
All right, Asia Equities reporter Winnie Su there. So, are China's stimulus measures going to work? Our next guest feels that the direction of travel is encouraging, and this can help to repair some of the confidence levels. Let's bring in Charu Chanana, Global Market Strategist and Head of FX Strategy at Saxo. So, Charu, thanks for joining us. There's obviously plenty of bulls out there, and what a difference a week makes. This time a week ago, nobody was really looking at China at all, and now we've got the likes of David Tepper saying that he's buying everything China-related. Do you share this enthusiasm?
Hi, thank you for having me, Paul. I certainly see that shift in tone coming through in, the Chinese policymakers. And you club that with the undervaluation that we've seen in the Chinese market. I think that is obviously making it a very interesting story at this point of time. But, when you come to think of it more deeply, the problem in China has not been about credit demand or the cost of credit so much. So rate cuts can only go, a small way to addressing those problems. The problem has really been about wealth destruction in the property sector, wealth destruction in the equity markets as well. We have certainly seen some efforts on those sides, but those are not things that can quickly turn around the story here. So, and I am, like you said, right, I'm sharing the enthusiasm around the tone from the policymakers. But for these kind of efforts to really have an impact and, change the story around structural headwinds that China is facing, one of deflation, one of the debt dynamics. The debt dynamics only get worse with the kind of fiscal spending that they need to do to revive the sentiment here. And, the demographics is certainly, again, a huge structural issue as well. I don't see those getting addressed as of now, of course. It's the balance sheet recession, which is going to be the near-term focus. But even for that, it needs a little bit more of a push from here and a continued series of follow-up measures as well.
Is part of the plan here one of optics to make that growth target of 5% realistic, to make that happen? Do you see it becoming realistic again, and do you have a target for growth yourself, or even a target for the CSI by the end of the year?
I would say they are obviously trying to get as close as possible to that 5% target. But certainly what Chinese authorities have proved to us in the last many months is that growth targets is not the only thing they now focus on, right? They've gone beyond to talk about the quality of growth, innovation, and the key sectors that they want to focus on for the long term. Obviously, strategic sectors mean a lot more to them. So we certainly are not going to get back to those double-digit levels of growth that we've been used to seeing in China for this past many years. I think they still want to justify the targets that they make. So I think we're going to get somewhere above 4.5%, closer to 5%. But that's really not the top of the agenda focus for Chinese policymakers as of now.
So is this going to ignite animal spirits as well? And more specifically, is it going to get consumers a bit of confidence to get out there and start spending again?
I think the animal spirits will only last as long as we see that momentum continuing in the announcements. For the consumers, like I said, the property sector measures don't really bring about a change for them quickly. So those who've been obviously stuck in that home ownership cycle and are obviously waiting for that to turn around, this is not a story that is going to change for them very quickly. I think if obviously Chinese people want to start seeing some gains coming through in the equity markets and they feel more confident about spending, I think those could obviously be some things to consider. But at the same time, we also have US election risk that is really on top of the radar for the market right now. And the manufacturing sector, what kind of an impact it could see if we were to see some adverse measures against China coming through after the elections. So I think those are still some of the headwinds that will not be addressed by the measures that we've seen so far. So I'm seeing it as a very positive step, but still a long way to go from here.
Just very quickly on that US election risk that you mentioned, our polls are very tight at the moment, but being tough on China almost seems like a bipartisan position right now. What sort of policy towards China from the US are you expecting post-November?
It's really hard to understand what the stance is, but like you said, right, in terms of deglobalization, I think the views of both the candidates are not very far. Obviously, the delivery, the style of delivery is going to be a little bit different. And if we do see some big headlines, things like what we saw earlier about 60% tariffs on all Chinese goods, that obviously will bring a lot of caution in the markets because that is huge. That is a huge risk for inflation. That is a huge risk for global growth as well. But I mean, if we were to get a more subtle delivery in terms of the rhetoric that we get there, I do think that this domestic momentum in China will be of a lot more relevance in that scenario, whether we are able to cope up with those tariff measures or not.
All right, Chari Chinana of Saxo is sticking around. In the meantime, let's get you to the US. Here's a look at some live pictures as Category 4 Hurricane Helene is now very close to making landfall on the Florida coast. So that Category 4 storm also accompanied by what is being described as a catastrophic storm surge and life-threatening winds as well. So Florida bracing for the landfall of Hurricane Helene. Still to come this hour, DBS Bank joins us to discuss the outlook for India's economy, including the potential impact of lower oil prices and a possible RBI pivot. This is Bloomberg. Japan's ruling LDP votes for a new leader in the next hour, with the winner set to become the nation's next prime minister. Our colleague Sherry, one of the most open races in the Conservative Party's history.
It's a crowded field of contenders vying for a job that comes with unprecedented challenges. The large field of candidates in Japan's ruling party election makes it likely that no one will secure a majority, which would trigger another round between the top two contenders. Among those on watch for a potential runoff, Shinjiro Koizumi, the son of a former prime minister who at 43 could become Japan's youngest prime minister. Shigeru Ishiba, a former defense minister who's running for the fifth time, and Sanae Takaichi, a hardline conservative who would be Japan's first female prime minister if she wins her party's backing. She's also one of the most outspoken on the Bank of Japan's policy path as an advocate of monetary easing.
She has basically said that the BOJ is making a mistake by moving as quickly as it is to raise interest rates. And frankly, I think that sets the Takaichi government up for possible conflict because she really wants easy money to continue.
Japan's next leader will need to grapple with geopolitical challenges as well, as the country gets pulled deeper into tensions between the U.S. and China. Tokyo faces threats of retaliation from Beijing amid pressure from Washington to tighten restrictions on sales of advanced chip technology. Adding to the uncertainty is the tight U.S. presidential race, though both candidates for the White House have opposed Nippon Steel's $14 billion takeover bid for U.S. Steel.
U.S. Steel should remain American-owned and American-operated.
U.S. Steel is now being sold to Japan. I will stop it. We got to do fast. We got to work fast, but we're not going to let it happen.
Some common ground for most of the candidates is the revival of Japan's nuclear power industry. 13 years after the Fukushima disaster, this is seen as a way to improve energy independence and reduce carbon emissions. Whoever wins Friday's vote is expected to call a national election soon, seeking to shore up support from a Japanese public weary of scandal and demanding sustainable economic growth.
Sherry on Bloomberg, Tokyo.
And we will continue our coverage of the LDP election with voting due to begin at about 1 p.m. Tokyo time. And we'll have a winner, or we expect to, about 3:30, and there'll be a news conference at around 6 p.m. in the Japanese capital. Just want to update you on Hurricane Helene, which has now made landfall in the Big Bend region of Florida. So this is a Category 4 storm. It's also accompanied by a catastrophic storm surge, life-threatening winds as well. This is according to the National Hurricane Center. So Hurricane Helene has now made landfall in Florida. We'll continue to update you on the progress of that hurricane. Let's get back now to Charu Chanana, Global Market Strategist and Head of FX Strategy at Saxo. And she's still positive on the yen, thinks, though, that gains are going to be more orderly from here. So, Charu, if we take a look at the yen right now, it's got a bit weaker, 145 at the moment. But considering policy divergence by the end of the year, we might have more tightening from the BOJ, almost certainly more easing from the Fed. Where are we heading from here?
So yeah, absolutely. I think yen has been quite a bit in focus, right? But there have been, very broadly speaking, two drivers for the yen strength that we saw over the last few months. Of course, this has been reversed now last few days, but it's really been a little bit about that yield divergence narrowing between the Fed and the BOJ. And secondly, it's been somewhat about the recession concerns globally, and that kind of giving a little bit of a safe haven bid to the yen as well. Now, with the Fed going for that 50 basis points rate cut last week, they have kind of shown a very strong commitment to achieving a soft landing. So those recession concerns, the odds have certainly gone down for that, and that's obviously weighing on the yen again. But the second part of the equation, which is the yield differentials, will continue to move in favor of the yen, which is why I see the yen strength potentially coming back into the end of the year. But for dollar yen to really go somewhere below 140, we need that trigger from recession concerns as well, because the positioning is very neutral now if you look at it from a speculative positioning perspective. So really, to nudge it towards the long end, we need those severe recession concerns that kind of bring the safe haven bid back to the yen.
Do you see there being much of an impact from the political dimension here? Because, as we mentioned a moment ago, we'll have a new prime minister in Japan, and one of the candidates, at least, Sanae Takaichi, one of the favourites, calling into question this idea of independence for the Bank of Japan. She's going to be pushing pretty strongly for looser monetary policy. Do you see that having much of an impact on the currency?
I would say yes, given the divergent policy stances that we've had from the candidates, it could obviously bring some knee-jerk reaction to the yen. And also, I think when you talk about the BOJ policy, we know there's been an added caution in there as well after that turmoil that we saw in the markets after their July 31 decision, right? So we've certainly been obviously, tracing back a little bit of that expectation of the Bank of Japan to hike rates from here, or I should say we've been pushing it to 2025. I think that caution is already there, and the markets have already priced that in, given comments from Ueda earlier. So we could obviously see some knee-jerk reaction, but I see eventually the yen will start to be, continue to be driven by those policy divergences.
Yep. All right, Charu Chanana of Saxo, thank you so much for joining us. We do have plenty more to come. This is Bloomberg. Let's take a look at how China markets are tracking this Friday. Risk on is all you need to know, really, with an asterisk. I'll get to that in a moment. But the Shanghai Composite now up better than 2%. This is after the index fixed that glitch, which was causing a delay a little bit earlier. So the Shanghai Composite surging again. The CSI 300 on track for its best week since 2008, better by 3.6%. The Hang Seng Tech Index having a 6% rally. The asterisk that I mentioned, China bank stocks not joining the party. And we have, of course, seen rate cuts in China as well. Agbank off 4% at the moment. We do have plenty more to come. This is Bloomberg.
The fact the Fed moved aggressively gives a lot of headroom to both China and Japan to moderate, or in the case of China, cut monetary or have loose monetary policy.
China will move away from a manufacturing economy to a consumption-based economy. So I think the consumption is the key where they're really helping out low and middle income families.
So it looks like they've taken the opportunity now to really do what they did, take out the playbook potentially. We still need to see the details, but this could be huge, and this could be the turning point, not just for China's markets, but certainly for the global economic cycle as well.
Expectation was extremely low, right? Position were low, valuation were low, and they came up with a big positive surprise. So sure, market responded, right? Hedge fund moved fast, but as market rally, expectations are building up. We need to see expectation versus what they deliver.
Some of our guests there reacting to China's latest stimulus measures. We've got China markets just heading to lunch, and this is how markets have been reacting to those latest stimulus measures. A risk on, very much so. The CSI 300 now better by 3.7%, on track to have its best week since 2008. Earlier we saw the Shanghai Composite run into a few problems. Just the sheer volume pretty much breaking the system for a little while. We're back up and running now, but the Shanghai Stock Exchange did have a few glitches. 101 billion of turnover in the first hour of trade today. The Shanghai Composite now better by more than 2%. So those benchmarks performing very, very strongly. A range of stimulus measures announced there. Cuts to the 7-day and 14-day reverse repo rates, and RRR cuts becoming effective from today as well. All right, for more on the markets and the reaction, let's get to Bloomberg MLive strategist Mary Nicola. Mary, does this qualify as bazooka stimulus?
It looks like it. If you look at what they've targeted in terms of they're looking to target the housing market, they're looking to target consumption. So they're looking at different parts of the economy that are obviously struggling. The key here for China is about stimulating consumption and bringing back consumer demand and consumer appetite. And of course, fighting deflation. And how do you fight deflation is really bringing up that consumer. So if they're looking to help people who are unemployed, looking to deploy stuff to support those in poverty and looking to support consumption, these are all key and absolutely critical drivers in getting the economy back on track. So of course it'll be about the implementation and how do these things come to light. But so far what they've said and the message they're sending is clearly that they want to get growth back on track.
Yes, well, the market certainly likes what it sees, but what data are we going to be looking at now to know whether or not it's worked, particularly around reviving the health of the consumer?
Yeah, it's going to require some patience from investors because obviously this isn't going to work overnight. We're going to need some time for it really to filter through the data. So, you're looking at the final quarter to really see a revival in the economy. So I don't think anything you'll see in October, but maybe in November and December, you'll start seeing little inklings of potentially how it works. Of course, house prices will be absolutely critical because they've lowered rates and potentially households can be refinancing. So that's one of the things in terms of have they put a floor under house prices and where is that headed? Of course, there's also if the momentum in the equity markets continues, obviously not at the same pace because it has been exceptional this past week, but if that's still a sign that households are shifting towards equities and regaining confidence, because remember that Chinese equity markets is very much dependent on retail buyers.
Yeah, so what are the risks here for equity markets? Because of course, if the data doesn't play ball over the final quarter, what's the risk that we could see some of these gains reverse? And also, you don't get anything for free. The debt's going to be piling up with some of these measures, surely.
Yeah, I think that there's always a case of there's always good debt and there's bad debt. So if they're using their debt to construct to improve domestic demand rather than, let's say, on infrastructure and building, let's say, unused houses or infrastructure that's really not necessary or needed. We know that impulse and the impact of that impulse has waned over the last few years in China. So it will be about how consumption unfolds. So things like retail sales. If retail sales doesn't come through in the last quarter, that's where the market starts to stutter. And of course, some of that will come through in Q4 earnings. I think Q4 earnings might be a lot more critical than, and even Q3, some of the outlooks from the companies. That's where you can see the market starting to stutter. But I think overall, there's still plenty of catch-up for Chinese equity markets to play, given how much they've really suffered over the last few years. And of course, you have valuations at exceptionally low levels, especially in comparison to peers. So for now, there's a lot of upside. And of course, we can't forget that tailwind from the Fed. And of course, the reaction from the fact that Saudi Arabia is looking to abandon its $100 per barrel price target. That also adds another tailwind to overall risk appetite as growth still looks to be headed in the right direction.
Yeah, planetary alignment for the moment at least. Bloomberg MLive strategist Mary Nicola there. Well, Bloomberg Intelligence expects Tier 1 cities in China to step up their support following those Politburo pledges. Let's bring in Bloomberg Intelligence real estate analyst Christy Hung. So, Christy, a shift in tone there from the Politburo signalling greater support for property. What difference do you think this is going to make?
Yes, so from the Politburo comments, you see thinking about forceful rate cuts, as well as, plans to stop the housing slump in China. You can sense that authorities are getting more desperate. But while, there is a change in tone and greater determination to support the property market, don't forget we are 3 years, actually over 3 years into a property crisis in China. So the damages to confidence are already done. And, we're also facing deep-seated structural challenges. So I think in terms of that, there's no quick policy fix to China's housing woes, especially when we talk about, re-anchoring household expectation on home price declines, as well as, easing the housing glut and also fixing the problem of unfinished homes. These are issues that could take months, if not years, to fix, and it's definitely not something that could be fixed overnight.
Yeah, so no quick fix. Does that mean we can expect to see some more policy coming in the next few weeks?
Yes, so in the coming weeks, coming days and weeks, expect, a fresh wave of supportive measures from city governments, especially Tier 1 cities. They have room to remove home purchase restrictions, especially in the suburbs. Tier 1 and Tier 2 cities, they have room to lower the down payment ratios, following up on PBOC's new rule to lower second home down payment ratio to 15%. And think about the timing of these announcements. This could be just right ahead of the Golden Week holidays in China. October is traditionally a peak season for Chinese home sales, along with September. In September, we are seeing, preliminary data showing, at least 30 to 40% decline in sales. And I think that explains why, the authorities are feeling the urgency to put a floor under home prices and home sales at this moment.
So let's talk about the proposed trillion capital injection into China's big state banks. How might that impact the property sector?
Yes, the hope is that with the capital injection, banks would have more capacity to take on credit risk. So I think there are two key areas of lending. One of them is to lend to purchases of unsold homes to convert into affordable housing. That is one key area. And the other one is whitelist funding to help completion of stalled housing projects. So these are two key areas that I talked about. How can we solve the problem, long-term problem of restoring supply-demand balances in China, and also easing concerns on the issues of unfinished homes, how developers have pre-sold the homes and not able to complete it. How do we restore buyer confidence in the pre-sales model of Chinese home sales again?
All right, Bloomberg Intelligence real estate analyst Christy Hung there. Still to come, we ask DBS Bank whether they think the RBI will pivot in October after the Fed kicked off a global easing cycle. Senior economist Radhika Rao joins us shortly. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching the India Focus, and let's take a look at Indian markets just ahead of the open. Unsurprisingly, looks like we're setting up for a positive day here. We have seen the Nifty futures cracking through 26,000 on Wednesday, pushing well past that now. So setting up for a positive day in India. It's a positive day in most other markets as well. Let's take a look at India's economic outlook now and get to our next guest, who sees GDP expanding 7.1% in the third quarter. That's up from 6.7% in the prior period. Radhika Rao is senior economist at DBS Bank. So Radhika, I want to dig into this call a little bit more. We've also perhaps got supporting your thesis a much lower oil price as well. So how do you see lower energy prices helping with that growth story and also helping tame inflation in India?
Certainly, lower import oil prices are certainly a big boon for the macroeconomic outlook. India does import about 80% of its requirements. So with oil prices trending closer to below 75, of course, the government hopes to see that level sustain for a while before they begin to cut domestic fuel prices. But as and when that's passed on, that would mean lower input prices for households, for corporates, and that will certainly be better on the purchasing power per se. But as it stands between the June quarter and the September quarter, we do think that this June quarter did have election-related disruptions, and we think some of that will even out into the September quarter, and that's why we have a slightly bias for a bit of a pickup in the growth momentum. So we should see that in a bit of consumption, a bit of investment up move as well. And coming back to your question on energy prices, not only growth, but on the current account fiscal balances as well. Typically, lower oil prices spells good news.
We've also got markets globally at the moment digesting this huge stimulus that we've had out of China. How do you see that impacting India markets and more to your beat, policy as well?
Certainly, markets watching China's stimulus very closely. As on date, it's still more to do with the monetary policy-related stimulus by way of lowering rates, providing some support to the real estate sector as well. But I think markets are really keen to see if the fiscal end will follow. And I think that is expected to have a bigger multiplier effect on growth. For India, I would think, what China's revival means for commodity prices will be quite important, especially commodity prices like metals, minerals, as well as energy as a broader basket. Insofar as policy is concerned, while I think India would be looking more at what the Fed did, and Fed did front load its rate cuts, by aggressive 50 basis points. Now, Fed is necessary, but not a sufficient condition for the RBI to ease rates. I think the governor has made it quite clear they're going to weigh domestic considerations. And when you look at that, what you see is that, in fact, inflation had gone down below 4% because of base effects in July and August. But the beat for food, beat for non-food, and base effects turning adverse, will see inflation again go up above 4% in September by the time they meet next in October, right? So putting that in view, plus we're going to have 3 new external members in the Monetary Policy Committee. So all of this put together, we think the October policy, there's a likelihood that the rates will be kept on hold. But we would be interested in seeing the commentary. Do they warm up to the idea that oil prices are down, food prices are edged down after seasonal disruptions? Does that make them, satisfied that inflation is headed towards the target and begin to ease rates? So we would be interested in seeing that, and I think that will open the door to a late 2024 rate cut.
Okay, so late 2024, but how likely is it, do you think, the RBI is going to see that movement on inflation that it needs to see? And do you think there is a need perhaps to revise the way that it looks at that inflation basket?
We do think that inflation is, on an annual basis, is trending lower. A year or so back, we were talking about 6 to 7%, and thereafter, the inflation is averaged in the 5% handle, and this year, we think it's going to be between 4.2 to 4.5. So the trend for inflation has been successively coming down. I think that's one thing that the central bank might take note of. The other one is that seasonal reasons, seasonal weather pattern related reasons does usually disrupt the disinflationary process around the middle of the year. And that has also come to pass this time, and we are after that, post that peak now. If you see high frequency data, perishable goods are coming down. So we think these would generally satisfy the central bank. And of course, the third one being the core inflation has been quite weak for the past, quite a few months now. So with these points in view, I think the central bank would be happy with them. But of course, they're also looking at, I don't think they will take their eyes off food inflation. And there was a discussion on whether they should look at core instead of food, just look at all the, pressures minus food. But I don't think they're going to agree on that. They've already mentioned that there is a clear correlation between how households think of food and what role that plays in their own inflationary expectations. So we do think that they would continue to remain focused on headline inflation, which includes food, fuel, and services as well, to get a more holistic picture on what households are facing at this point. So putting all these things together, obviously they are concerned about inflation, but I think inflation is trending down for sure.
Right. I just want to get back to your growth call as well that we mentioned at the start. It is quite an aggressive one, and certainly the growth story in India is compelling. But what are the risks around that? Because we have seen urban consumption slowing, car sales slowing as well. How do you see that impacting your growth forecast?
Certainly, we will be looking at quite a few factors. The first one being, of course, that we had seen urban consumption fare better last year. Going into, when I say last year, I mean the fiscal year. And coming into the mid of 2024, we are seeing some softness creeping in, especially into urban demand. But part of that is being compensated by better looking rural demand indicators. For example, if you look at the FMCG volume growth, you've seen a pickup. You have seen, rural employment scheme take up slow down. So these are, and then whether monsoon in general has fared better, that has helped sowing. So these factors seem to suggest that rural households, rural demand is coming back slowly but surely. So I think that is a bit of a compensatory effect. But nonetheless, I think there is certainly a band of risks, especially from global growth and trade perspective, because India's exports did fare better. They are now slowing off late. The trade balance is, the deficit is widening. So we would be looking at that very closely. And broadly, if inflation, which we see trending down, does that creep up again? So there is a risk band around the growth forecast, but we do think that on average, we would be closer to 7%, which would again be a mark down from 8+% last year.
Okay. All right, Radhika Rao, we're out of time, but thank you so much for joining us. Radhika Rao is Senior Economist at DBS Bank. Well, Tokyo Electron CEO Toshiki Kawai says the rush into AI chips still has more room to run as a wealth of developing industries will drive more demand in the coming years. Our exclusive conversation also included Japan's biggest chip equipment maker's outlook in its key market of China, as well as a new partnership with Tata Electronics in India.
I think we'll continue to see growth in the AI segment. Growth in the AI server segment is forecast at an annual rate of 30% in the years 2023 to 2028. Combined with the introduction of more AI-related applications for PCs and smartphones next year, I expect a very strong growth. There's no doubt about the growth potential of artificial intelligence, but I think the market is focusing too much on that particular segment. I think the market has just crossed the threshold of the second phase of AI. Our projection is that overall chip demand will double in the next 5 years to $1 trillion in 2030, boosted by artificial intelligence, as well as augmented reality, virtual reality, and autonomous driving.
A big chunk of your business also comes from China. More than 40% of your revenue in the last fiscal year came from China. Do you expect this level of demand to continue, or has a lot of it been front-loaded by Chinese companies expecting more restrictions coming from the US and its allies?
A period of inventory correction last year suppressed investment into the high-end memory segment. On the other hand, investment into China grew because of initiatives over the last few years to increase capacity there. As a result, China sales grew to 40% of overall revenue. Now that the initial investment phase is over, China sales will likely fall below 40% in this second half and eventually settle down to 25 to 30%.
The repairs and maintenance of Tokyo Electron equipment, which is sort of how you keep also the trust from your customers, right? Could you see some restrictions on that, and are you concerned about that?
The importance of semiconductors remains unchanged. Given the global trends in digitalization and decarbonization, there will always be investment opportunities somewhere.
Let's talk about your new markets, because I know you just returned from India as well, and I just launched a partnership with Tata Electronics. But the partnership is very small so far, right? You're providing some engineers and services and training. How do you expect this partnership to grow in the next few years?
India's economy grew last year at a pace that far exceeded the US, Europe or China, and definitely Japan. So we're very excited about this new business opportunity in India. We see our strategic partnership with Tata as a high-value business opportunity. It's not just about contributing to Tata's chip business, but the development of India's chip sector. I'm looking forward to this new exciting chapter.
When could it turn out to be as exciting as the Chinese market has been for Tokyo Electron? When could it start offsetting some of the challenges that we might encounter with policy against Beijing at the moment?
We'll monitor the measures and curbs by governments and how they affect our business. I believe that as long as we keep offering high-level technology that is essential to customers, our efforts will lead to deals and growth for us.
That's Tokyo Electron CEO Toshiki Kawai speaking exclusively to Bloomberg, the Asia Trade co-anchor Sherry-Ann. Plenty more ahead. This is Bloomberg. Welcome back to Bloomberg Markets Asia. Japan's ruling Liberal Democratic Party set to vote in a few minutes' time for a new leader. Now, the winner, of course, virtually assured of becoming the country's next Prime Minister. Subscribers can go to TLive Go, that's TLIV Go, on their Bloomberg to get commentary and analysis from Bloomberg's expert editors. Let's take a look at how Japan benchmarks are tracking at the moment. Nikkei having a reasonably good day, better by 0.5%. Bit of a mixed bag by sector, though. IT stocks among the best performing. Energy, though, suffering quite a bit. That sector off 2.7%. We do, of course, have a much weaker oil price. Also weaker, the yen there, 145.17, although the consensus is that we will see the currency strengthen going forward. In terms of strengthening, take a look at the Hang Seng Index, better by 3.4% at the moment. That is now on track for its best week since 2007, and certainly superlatives abound when it comes to looking at Hong Kong and China stocks at the moment off the back of the stimulus that we've seen from policymakers in China. So we see most of those major benchmarks in strongly positive territory. CSI 300 better by 3.7%. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa up next. This is Bloomberg.